Good evening, everyone. Last video, we talked about uh, inventory valuation, specifically the lower of cost and net realizable value. So we talked that past due requires inventories to be valued at lower of cost and net realizable value. In this video, we will be talking about inventory estimation methods. So why do we need to estimate inventory if the requirement is lower of cost and net realizable value? Well, simply put, physical counts may not be possible at all times. So sometimes it's necessary to approximate inventory value. Also, even if physical counts are possible, it may prove too costly, difficult, or inconvenient. So possible examples of these circumstances are when inventory is destroyed by fire. So you need to estimate it for insurance purposes. Another is when you made a physical count, but you want to check if it's correct or reasonable. So you make an estimate to see if it's close. Another is when you're making interim financial statements or financial statements in between periods. So when you're preparing interim financial statements, a physical count may not be necessary or it may take a long time. So you need to just estimate inventory value. There are generally two methods that are widely accepted in estimating inventory value. In this video, we will be talking about the gross profit method. So what's the gross profit method? It assumes that gross profit rate and consequently the cost of goods sold to net sales ratio remains approximately the same from period to period. There are three steps to estimate inventory value in the gross profit method. Step 1, you have to determine the gross profit rate and the corresponding cost ratio. So it's called the cost ratio if it is based on sales, or the GPR is based on sales, and it's a sales ratio if gross profit is based on cost. Once you have the cost ratio or the sales ratio, you have to compute the estimated value of cost of goods sold by multiplying net sales to the cost ratio, or if you have the sales ratio, you have to divide net sales by the sales ratio. When you're computing net sales, you have to take into account sales returns only. So you don't have to take into account sales allowances and sales discounts. Step 3, you have to compute the estimated value of ending inventory using the formula of beginning inventory. You add on net purchases to get the goods available for sale during the period. You deduct your estimated cost of goods sold that you got in step 2, and then you compute for the estimated cost of ending inventory. So let's take an example. So let's do problem 13-1. So here, gross profit rate is based on sales. Average company has a recent gross profit history of 40% of net sales. So you're given the following data. Your inventory on January 1 is 650,000. You have purchases from January 1 to March 31 of 3.2 million. Net sales of 4.5 million during the period. A purchase return or purchase returns of 75,000 and freight in of 50,000. So you're asked for the estimated inventory on March 31. Step 1, since we're given a gross profit rate based on sales, so we have to compute for the cost ratio. So it's simply 100% minus your GPR. So we have a GPR of 40%, so 100% minus 40%. So we have a cost ratio of 60%. This means that for every dollar of sales, there's a 0.6 dollar of cost of goods sold. Step 2, using the cost ratio, we can estimate our cost of goods sold. So we have net sales times cost ratio. So net sales of 4.5 million times 60%. So we have an estimated cost of goods sold of 2.7 million. Using our results from step 2, we can now answer the question or estimate the cost of our ending inventory. So if you look at this, you have beginning inventory of 650,000. You add net purchases, so 3.2 million net purchases during the period, plus freight in of 50,000, less our purchase return of 75,000. We have net purchases of 3,175,000. So our goods available for sale will be 3,825,000. We deduct cost of goods sold estimated from step 2 of 2.7 M to arrive at our estimated cost of ending inventory on March 31 of 1,125,000. Now, what if we were given a gross profit rate based on cost? So, average company has a recent gross profit history of 40% above cost. So, what does that mean? That simply means that your sales versus your cost of goods sold will be 140%. So 100% plus your GPR based on cost. So since sales is 140% of cost, you have to divide net sales by the sales ratio to arrive at the estimated cost of goods sold. So 4.5 million divided by 140%, so we get 3,214,286. Using this figure, we can recalculate our estimated cost of ending inventory on March 31 to be 610,714. Let's do another example with sales discounts and allowances and sales returns. So Karen Company reported the following information during the current year. So you have 5 million in beginning inventory. You have purchases of 26 million, freight in of 2 million, purchase returns and allowances of 3.5 million, purchase discounts of 1.5 million, sales of 40 million, sales returns of 3 million, sales allowances and sales discounts of 500,000 and 1 million respectively. You took a physical inventory at year end and it resulted in an ending inventory costing 4 million. Also at year end, you have unsold goods on consignment with selling price of 1 million that are in the hands of a consignee. You're given a GPR of 40% on sales. Step 1, since you were given a GPR based on sales, so it's just 100% minus 40% and you get a cost ratio of 60%. Step 2, net sales times your cost ratio. But to arrive at net sales, we only include sales return and sales in the figure. So net sales would be 37 million, 40 million minus 3 million. So we disregard sales discounts and allowances. So 37 million net sales times 60%, we get an estimated cost of goods sold of 22.2 M. Step 3, you get goods available for sale. So net purchases of 26 M plus freight in of 2 million minus your purchase returns and purchase discounts and allowances of 5 million. So you get net purchases of 23 million. Add it to the 5 million beginning inventory. You have goods available for sale of 28 million, less the estimate you got in step 2 of 22.2 M, and you have an estimated cost of ending inventory of 5.8 M. Now, this is what is good about estimating inventory cost. Since you have 5.8 M as an estimate, now you can see how much was actually lost, or the cost of inventory shortage. You have to compare it with your records. So per record, you have 4 million in ending inventory, and you have 600,000 inventory out on consignment. So we arrive at 600,000 from the cost ratio of 60% multiplied by the retail, or the uh, selling price of our consigned goods. So you have a total of 4.6 million inventory per your records. You have an estimated ending inventory of 5.8. So there is a shortage, or an estimated shortage of 1.2 M. So that's quite large. So you have to investigate what happened. What was there a Is this normal, or is this abnormal for your operations? So given that it's 1.2 M, and you should have an estimated ending inventory of 5.8 M, so that's about almost 20%. So what happened to your inventory? Is it a normal spoilage, a normal did you was the inventory not counted, or maybe was the inventory stolen? So that's it for the gross profit rate method, and I will talk about the retail method in another video.